further? Do we need, a signal from a Warsh-led Fed in mid-June that, well, the market may be pricing in a hike, we could actually cut rates?
I mean, if I took a step back, oil has moved in a way, and it's created inflation in a pipeline in a way that financial conditions have to tighten later this year. So I think the bond market is pricing in a hike now instead of easing. And I think as long as that's what the bond market's pricing, it is tougher for a lot of groups to rally because most groups need a dovish Fed.
Yeah, no, but if some people say, well, the bond market leads the Fed, with a new chair with a decidedly different view on not only the mechanics of inflation, but the dealing with, how he wants to put his own stamp on this, that maybe this is the Fed that's going to lead the market. Like maybe the market's wrong.
Yeah, I mean,
can you see a Kevin Warsh-led Fed with he as chair hiking rates anytime in the near future?
I think Kevin Warsh has a very difficult task because the bond market already has its template. He wants to cut rates but shrink the balance sheet, so there's a lot of sterilization taking place there. It's almost as if someone takes over the role as CEO of a company and says, we've got a new way of telling our story. Investors will be skeptical at first, and I think that's why the market will test this Fed.
Sir, to 25%. What structurally changed during Q1 reporting to cause such an unprecedented spike in forward estimates?
That story is brought to you by the letters A and I. That was the story. There was just a mass underestimation of how parabolic earnings has been. And there was also a decent amount of breadth in earnings. It wasn't just about AI. Most sectors saw an improvement. And I think analysts just had a heightened sense of caution, especially given that the third month of the quarter represented the first month of the war. And I think in that kind of environment, analysts were not inclined to raise the estimate bar. And then earnings season began. That clearly had to happen. You see the line that's gone parabolic, that was the first quarter, and that caused estimates for the remaining three quarters, as well as the full year calendar 26 numbers to go up. So this has been the most important underlying fundamental support for the bull market.
And I mean, that chart there is quite dramatic, that upside down hockey stick trajectory for the quarters in 2026 here. Is that rate of change sustainable for the second half, or do you feel that analysts may have overcorrected and we could be set up for disappointment here?
Well, I think that there is some risk of extrapolation and assuming that the pace of growth is going to persist. And that's one of the messages that we've been imparting, that in contrast to, say, the late 1990s, when the bubble was in the P, valuations were a bubble because there was no E in many of the leadership companies. In this case, you've got an extraordinary amount of E in the PE equation, and as a result, you've actually seen multiples come down. What I worry a little bit about is that the expectation bar has gotten so high that the margin of error changes a little bit relative to what we've seen in the past. And you might just get one-off troubles or maybe industry troubles as a result of some sort of miss, even if it's a marginal miss. So I do think that there is that potential for some volatility under the surface because that expectations bar is so high.
And where do concerns about inflation and rates come into play here? Do they threaten these elevated estimates?
So, the 10-year yield has the highest correlation in terms of equity market performance, and that has calmed down a bit. And I think that's been supportive of the market, too. The small cap rally, though, to some degree, which has been a strong rally. Oh, here actually, there's a chart showing the inverse correlation between the 10-year Treasury yield and the S&P 500. And you see that's in steep negative territory, and it's bounced around over this period of time. But I think this could be a secular change, representing a period where inflation volatility is a higher concern. And when you've got the 10-year yield keying off inflation more so than growth, that tends to be to the detriment of equities if inflation and the 10-year yield in turn are rising. So there are some benefits coming ahead of us in terms of the inflation trajectory by virtue of the base effects and obviously oil coming down. The problem is that the inflation story is a bit broader than just oil. In fact, AI is a component of the inflation story. So I don't think we're out of the woods yet. We may still have some upside. You still got some tariff pass through. So our base assumption is that the Fed is in a position to have to consider rate hikes this year.
And are the markets more sensitive to Treasury yields now than they were a year ago with the setup that we have?
Yeah, much more so. And again, it's been ebbing and flowing. That chart you showed before is only a few years. But I'm going to tease out a report that Kevin Gordon and I are going to write for the next publishing day, and I'll post it. And it's going to be a more secular look at the relationship between the bond market and the stock market, and in particular, bond yields relative to stock prices. We had the Great Moderation era that went on for about 25 years up until 2022 or so, and you had bond yields and stock prices moving in the same direction. The 30 years prior that was not the case. So we're going to take a longer term look at the data you're seeing here.
And if the Fed is in fact forced to move back to this explicit tightening bias, can these earnings continue to carry the heavy load?
Something very unusual is happening in the semiconductor market right now. Some of the strongest stocks in the entire AI trade are falling sharply. Micron has experienced a major pullback. Samsung reported enormous profit growth, and yet investors sold the stock. Semiconductor equipment companies that has benefited from the AI infrastructure boom are suddenly under the pressure. And once again, the market is asking the question that appears every time chips stocks experience a correction. Is the AI semiconductor cycle is finally approaching its peak? Or are the investors making the mistake of confusing volatility with a fundamental slowdown? Because when we look beneath the stock prices, the situation becomes much more interesting. The semiconductor industry is currently experiencing one of the strongest demand environment, and it has seen in the decades. Artificial intelligence is consuming enormous amount of computing power that requires GPUs. Those GPUs require high bandwidth memories. Data centers require networking equipment. They require CPUs. They require storages, and they require power and the cooling infrastructure. Producing all of those semiconductor requires a manufacturing equipment and advanced fabrication facilities. AI has created a chain reaction throughout the entire technology infrastructure economy. And according to Bernstein semiconductor analyst Stacy Rasgon, this is the most unusual semiconductor cycle he has ever seen. Normally, semiconductor cycles are relatively constant. A new smartphone cycle increases demand for certain chips. A shortage causes price to rise, and inventory correction causes orders to decline. But the current cycle is different. Artificial intelligence is creating bottlenecks across almost every layer of semiconductor supply chain. First, the market couldn't get enough Nvidia GPUs. Then the high bandwidth memories become the constant, and the semiconductor manufacturing equipment benefited. Then the optical networking components, the power and semiconductors, then the CPUs, and now additional shortages are appearing across the data centers ecosystem. Essentially, AI spending has become so large that the bottleneck keep moving. Every time the industry solves the one constant, another constant appears somewhere else. And this explains why semiconductor stocks have experienced so well. Investors has been following the bottlenecks. Whenever demand significantly exceeds the supply, pricing power increases and revenue increases, margin expand, and the earning expectation move higher. But here is something extremely important. The semiconductor rally has not been driven entirely by multiple expansion. In other words, stock prices haven't simply increased because the investors are willing to pay higher and higher valuation. A significant portion of the rally has been supported by earning growth. The stock increased because the companies are making more money. And that's the one reason the semiconductor industry remains so important for the broader stock market. Companies like Nvidia and the Micron are expected to contribute significantly to earning growth. Their businesses are benefiting directly from the enormous amount of capital being invested in artificial intelligence infrastructure. But even the strongest investment cycle experienced correction, and the Micron is a perfect example. The stock experienced an extraordinary rally. Investors become increasingly optimistic about the memory shortage. High bandwidth memories demand increased and memory prices improved. Micron earning exploded, and suddenly a company historically viewed as cyclic memory manufacturers become one of the biggest beneficiaries of the AI infrastructure boom. But after such enormous move, the stock became vulnerable. Expectations become extremely high. Investors had enormous profits, and eventually some investors began taking off money off the table. Stock corrected sharply, and immediately the narrative changed. Suddenly, investors began asking whether the memory demand had peaked, whether the semiconductor momentum trade was finished, and whether the additional manufacturing capacity would eventually create oversupply.